In this and the next few sessions, we will look at corporate bonds. Corporate bonds represent long-term debt securities issued by corporations. Invariably, corporate bond issuance is governed by a bond indenture, which is a legally enforceable document that covers several aspects relating to the bond issue and details the obligations of the issuer of the bond and the privileges and rights of the investor in the bond. The legal system in most countries require that for large bond issues, a trustee be appointed to protect the interest of the investors in the bond. The trustee represents the investors in all matters relating to the bond issue and is responsible for ensuring compliance by the issuer of the bond to the terms specified in the bond indenture. Every bond issue carries some characteristics that differentiate it from other bond issues. Let's understand these characteristics in some detail. Term bonds versus serial bonds. In a term bond, the entire bond issue matures on a specific single date in the future, whereas serial bonds mature on pre-specified dates with a portion of the bond issue paid off on each maturity date. And then we have debentures. Debentures are backed only by the general credit standing of the issuing firm, not secured by a specific asset or collateral. On the other hand, if you look at mortgage bonds, proceeds from such bond issues are deployed to create specific assets that are in turn pledged as collateral for that bond issue. Convertible bonds. These bonds can be exchanged for another security such as equity shares of the issuing firm as per the pre-specified terms and at the discretion of the bondholder. Convertible bonds are popular with investors for several reasons. A, it is not merely a bond but loaded with an option. For instance, a bond that can be converted to equity stocks of the issuing firm at a future date carries a stock option. And B, the price and yields quoted for convertible bonds will therefore reflect the value of the embedded option. Hence, their prices and yields vary more than their non-convertible equivalents. We also have bonds with call and put options. Bonds with a call option give the right to the issuer to buy back the bonds from the bondholder prior to maturity date. Bonds with a call option expectedly, therefore, command a higher coupon rate than those without a call option. Bonds with a put option, on the other hand, gives the right to the investor, i.e. the bondholder, to sell the bond back to the issuer prior to the maturity date. Bonds issued with a put option, therefore, will command a lower coupon rate. Sinking fund provision. This is a requirement to ensure that the issuer of the bond retires or repays a certain amount of the original bond issue every year. Say, for a 20-year bond, repay 5% of the bond issue size every year starting year 10 and the balance on the maturity date. Subordinated debenture. In the event that the issuing firm has to be liquidated for any reason, claims by the holders of subordinated debentures are junior to both the mortgage bonds and the regular debenture bond issued by the same firm. Now let's look at trading in corporate bonds. Bond markets worldwide are among the largest in most financial markets. Corporate bonds are issued either through an IPO or an initial public offer or through private placements. Thereafter, the bonds are traded in the stock exchanges where the bonds that are issued are listed. The trading process for bonds is very similar to that of equity shares. In several countries, however, a significant portion of bonds are traded in the OTC market or over-the-counter market dominated by large bond dealers in that financial market. Hence, price quoted in the exchange-traded market for bonds could be inaccurate because their volumes are significantly lower than the same bond traded in the OTC market. Furthermore, because of the significant OTC market, there exists a very high probability of low liquidity in the market for these bonds. Valuation of corporate bonds. The price of bonds or the value of bonds is determined using the present value equation, which you would all be very familiar with by now. And the present value equation is the sum of the discounted value of future coupon payments as well as the face value of the bond on maturity, where C is equal to the annual coupon payment on the bond, I is the yield to maturity at that point in time, N is the number of years to maturity, and FV is the face value of the bond. Most corporate bonds pay coupon semi-annually, that means twice a year. Hence, the price or value of an N-year corporate bond that pays coupons semi-annually is computed as, please note, the coupon divided by 2 because it's paid twice every year, C being the annual coupon rate, and I, which is the yield to maturity, should therefore also be divided by 2. We will also work through some more problems in the discussion board to further consolidate your learning.